Good afternoon. Welcome back to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Inside ETFs in Hollywood, Florida. And now we're meeting with Brad Ball. He's the CEO of Liquid Strategies and Overlay Shares. We're going to take a look at volatility, risk premium, and some products you can use to help mitigate that. It's great to see you. As always, thanks for joining us at Inside ETFs. And let's learn more about volatility, risk premium, what that is, and how you can harvest that with overlay shares.
Sure. So a lot of investors are unaware of sort of what volatility risk premium is, and really all it is it's insurance premium. Investors spend money to protect against certain events happening. It could be the market going up or the market going down, and so like most kinds of insurance, people spend money on that insurance that they don't need, and so oftentimes those insurance contracts, in this case options, expire worthless or strongly diminished. So rather than being a purchaser of options, we're a harvester or a seller of those options, which generates premium for our investors.
So is it a call writing strategy around the underlying basket?
So it's a put writing strategy, so similar to a call writing strategy, but what we're really doing is selling downside market protection. And investors tend to pay more for downside market protection than they do for calls, so we find it to be more beneficial to sell those types of options. But what we do is we add this as what is known as an overlay, so it sits on top of other investments. So what we can do is do this volatility risk premium overlay on top of other things to generate incremental return.
All right. Now, it's a strategy that will also help you recalibrate risk as well. I mean, if going into the past couple of weeks, the trajectory was all the way up. This past Friday and Monday, clearly you can see some of that volatility come back into the market, so it allows you to kind of reassess and recalibrate. Absolutely.
In fact, I think one of the number one things we hear from advisors and from investors is that, well, where am I going to put my money? I had the stock market up 31% last year. I got bonds up 12%. So, what is an investor to do? And so one of the things that happens is a lot of people have the feeling that, well, maybe bonds have already performed their role in your portfolio. So a lot of investors have just stayed invested in equities because it's like, well, how much lower can rates go? So what we give, for example, is investors a way to say no, invest in our OVB product, that stands for overlay bond, where you get the Lehman aggregate, but you get our overlay on top of it. So instead of getting maybe a 3% return in your bonds, you get a 3% return plus our overlay on top of it. So the combination of the two now can actually compete for dollars. So maybe it's not as high as what equities have been, but maybe it's higher than equities will be.
Right, or where they are right today is a perfect example for that. Let's talk macro a little bit. Do you think that we'll see more volatility in 2020 as compared to what we saw in 2019? And with that, interest rates, do you think we'll still continue to have a very dovish environment there?
Yeah, I do think we'll continue to see volatility, but that would be expected and welcome. I think many investors forget that the average VIX, if you look at the last 20 years of VIX, the average VIX is more like 18, 19. It's not this 12, 13 we've been living in. And so we've become accustomed to almost no volatility, the type of volatility that indicates the market's going to move less than 1% a day. I think it's been 70 days since we had a market move of 1% or greater. So people start to get acclimated to that, and they shouldn't get too acclimated to it, because as soon as you do, the market will take you the other way. But I do think that we should expect the market to have more volatility than we've had. I think if you look at things like whether it's continuation of the China trade talks, whether it's follow-up phase 2, or if it's the election results, or if it's this coronavirus, whatever it is, there's always things that the market may not see coming, but eventually kind of trip the market up. And so I think at all times it's good to kind of keep an eye towards volatility.
All right, Brad, thanks so much for joining us at Inside ETFs. And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.